Livermore understood that the market is inherently unpredictable in the short term, but the psychological responses of the speculator are entirely predictable and dangerous. These 10 golden rules are the distillation of decades of costly lessons, formulated specifically to mitigate emotional trading and incorrect position sizing, which Livermore identified as the primary destroyers of wealth. These principles are designed to ensure that the speculator remains solvent long enough to capitalize on the inevitable major movements that follow the line of least resistance. They force the operator to adopt a defensive mindset, prioritizing the protection of the available capital over the pursuit of immediate high-risk profits. The rules serve as an intellectual framework, demanding discipline far superior to that required for simple prediction or analysis. Before we delve into the core strategies that separated Livermore from the masses, please take a moment to subscribe and leave a quick comment below. Even just a single word or a quick thank you greatly helps the algorithm recommend this video to more people who need to hear these timeless lessons. This simple action shows me that this kind of deep dive content truly matters and is worth the extensive effort required for creation. And remember, the channel is always here as a resource to return to during challenging times, when trading becomes difficult and your confidence starts to waver, offering the practical wisdom required to regain your footing. Livermore's first and most crucial rule was absolute. Liquidate a position immediately if the market moves against your initial entry point by a defined, predetermined amount. He viewed every loss not as a failure of analysis, but as proof that his timing or premise was fundamentally incorrect at that precise moment. Holding on to a losing trade in the hope that it will recover to the break-even point was, in his experience, the single greatest psychological trap. This waiting game transformed speculation into gambling, relying on luck instead of disciplined execution. He famously stipulated that no position should ever be allowed to move against the speculator by more than 10%, though the specific percentage must always be tailored to modern volatility and personal capital. This strict liquidation point acts as a firewall, preserving the vast majority of the capital for better confirmed opportunities. The moment the market disproves the initial judgment, that capital must be instantly freed up for reuse. The concept is brutally simple yet profoundly difficult for most speculators to execute due to ego and denial. The emotional cost of realizing a loss is often what prevents traders from adhering to this rule, leading them instead down the path of disastrous inaction. Livermore recognized that the market does not care about the speculators' feelings or their potential for recovery. The only objective reality is the price on the tape, and if that price is moving against the position, the decision is already made. The realization that the first loss is invariably the cheapest loss became a foundational pillar of his entire methodology. Every single point a position drops past the predetermined stop-loss represents capital that must be earned back before any profit can be realized. This compounding difficulty makes recovery exponentially harder the deeper the loss becomes. Therefore, the immediate execution of the stop-loss is the ultimate form of capital preservation. This rule eliminates the catastrophic risk of a small mistake escalating into a portfolio-destroying event, ensuring survival until the next clear opportunity arises. The discipline required to cut a loss quickly is the defining characteristic of a successful speculator. Separating them from the amateur, it requires intellectual honesty to admit error the moment the market provides confirmation. This rule is not a suggestion, but a mandatory operational procedure, designed to protect the trader from their own inherent psychological weaknesses. Livermore treated the stop-loss as an insurance premium against ruin, willingly paid to maintain his solvency. The second golden rule is the direct corollary to the first. Never, under any circumstances, buy more of a security that has declined in price. Livermore considered the act of averaging down to be compounding an error, throwing good money after bad in a misguided attempt to reduce the average cost. This strategy is rooted in hope, the very emotion he sought to eliminate from his trading decisions. If the initial position is showing a loss, the market is confirming that the timing or analysis was wrong. Increasing the exposure to a position that is already moving against the speculator exponentially increases the overall risk profile. It transforms a manageable initial loss into a potentially catastrophic situation, especially if the underlying trend accelerates against the position. Averaging down is the antithesis of disciplined risk management, as it forces the speculator to hold a larger, more vulnerable position based on the hope of a reversal. Livermore maintained that the market is the ultimate judge, and fighting its confirmed direction by adding capital is a fool's errand. The only acceptable time to increase a position is when it is already showing a substantial profit, proving the initial judgment was correct. Adding to a losing position is a desperate measure, usually taken when the speculator is already emotionally compromised and unable to think clearly. This action often leads directly to the margin call trap, forcing a full liquidation at the lowest possible price point. The successful speculator must understand that the market owes them nothing and will punish attempts to manipulate average cost through reckless additions. This rule emphasizes the importance of acknowledging error immediately and moving on to new opportunities rather than trying to salvage a failed trade. Capital is a finite resource, and it should only be deployed where the market has provided positive confirmation of the initial thesis. Deploying capital into a losing trade is wasting valuable resources on a proposition the market has already rejected. Livermore's success was built on maximizing capital efficiency, which demands exiting errors swiftly and completely. The temptation to average down is powerful because it offers the illusion of control and a quick path back to break even. However, this illusion quickly evaporates when the price continues to drop, resulting in losses far greater than the original manageable amount. Adherence to this rule ensures that the speculator's capital is always chasing success, never trying to rescue failure. This principle is a cornerstone of intellectual integrity in speculation. Livermore taught that one must wait patiently for the market to confirm the direction of the major trend, identifying what he called the line of least resistance. True speculative opportunity only arises when the trend is clearly established and the risk of counter-trend movement is minimized. Jumping in prematurely, trying to anticipate the exact bottom or top of a movement, is an act of high-risk gambling that wastes precious capital. Patience is not a passive virtue in speculation. It is an active risk management tool. Premature entry carries two major risks. First, the risk of being wrong and incurring a stop loss, and second, the risk of tying up capital in a sideways or uncertain market. Capital tied up in indecisive positions cannot be used to exploit clear, high-probability movements. Livermore believed that the vast majority of time the speculator should be completely out of the market, waiting for the optimal entry point. He understood that missed opportunities are far less costly than poorly timed entries. To manage the risk of premature commitment, Livermore sometimes employed pilot trades, which were extremely small initial positions. These tiny trades were not intended to generate significant profit, but served solely as a test of the market's immediate direction and volatility. If the pilot trade moved against him, the loss was negligible, providing valuable information without jeopardizing major capital. If the pilot trade moved into profit, it provided the confirmation necessary to begin scaling up the main position. This disciplined waiting prevents the speculator from being whipsawed by minor market fluctuations, preserving both capital and mental energy. The true profit comes not from entering early, but from entering correctly, right as the major movement is beginning to accelerate. Confirmation means allowing the market itself to tell the speculator when it is time to act, removing the guesswork and emotional anticipation from the decision-making process. The market will always provide ample time for disciplined entry once the path is clear. Livermore's method for increasing position size, known as pyramiding, is the direct opposite of averaging down and is fundamentally a risk management technique. Pyramiding involves adding to a winning position only after the earlier tranche shows a substantial confirmed profit. This means that the increased exposure is financed by the market's money, the paper profit, significantly reducing the risk to the original trading capital. This phased approach ensures that capital is never overcommitted until the trend is fully established and proven. The structure of correct pyramiding is critical. Each successive tranche added must be smaller than the one before it. For example, if the initial purchase is 500 shares, The next edition might be 300 shares, and the final edition 100 shares. This structure ensures that the largest portion of the capital is deployed at the lowest, most favorable price, maximizing the base profit and minimizing the risk associated with the highest entry points. It is a methodical way to increase exposure while managing the average cost effectively. This method serves as an anti-leverage principle in the context of risk management, because it only utilizes leverage or increased exposure when the market is actively confirming the trade. If the market suddenly reverses, the smallest positions are the most vulnerable, but the core position remains profitable and protected. Pyramiding ensures that the speculator is always trading with the trend, leveraging success rather than rescuing failure. It is a strategic deployment of capital that demands patience and proof of concept. Pyramiding demands that the speculator must be comfortable leaving money on the table, resisting the urge to buy the maximum amount immediately. This restraint protects the capital base from unforeseen volatility during the early stages of a move. The goal is to build a large position slowly and safely, only adding size when the market provides clear, unambiguous validation of the original analysis. This disciplined scaling is a hallmark of professional speculation. When considering the methodologies required for effective market timing and trend confirmation, it is helpful to explore historical precedents that focused on these very principles. Richard Wyckoff, a contemporary of Livermore, developed highly detailed methodologies for analyzing market cycles, accumulation, and distribution. If you are serious about mastering the foundational techniques of market structure and identifying when major shifts are truly underway, then you must explore the Wyckoff perspective. The Richard Wyckoff Trading Methods channel offers a deep dive into this crucial methodology, providing comprehensive analysis and practical breakdowns of these complex cycles. It is an invaluable resource for any serious speculator looking to enhance their understanding of market structure and improve their timing, directly complementing Livermore's focus on trend confirmation. You can find the link to the Richard Wyckoff Trading Methods channel below in the description. Livermore's fifth rule states unequivocally that the market is never wrong, but the individual operator's opinion often is. The fundamental risk principle here is that the speculator's personal analysis, bias, or intellectual vanity must always yield to the actual price movement reflected on the ticker tape. Fighting the tape means taking a position contrary to the prevailing major trend, a high-risk activity that Livermore strictly avoided. The tape provides the objective truth, regardless of what theories or fundamental analyses might suggest. The danger of intellectual vanity arises when a speculator believes their analysis is so superior that they can correctly predict a reversal before the market confirms it. This leads to counter-trend speculation, which is inherently risky and often results in rapid, significant losses. Livermore learned that the market will continue moving along the line of least resistance far longer than most people anticipate. Attempting to call the top or the bottom based purely on opinion is a recipe for ruin. The application of this rule is simple yet demanding. Only speculate on the side of the major movement, ensuring that the prevailing trend dictates the direction of the trade. If a stock is trending down, the line of least resistance is down, regardless of how cheap the stock may appear fundamentally. Speculation should be limited to the direction that offers the highest probability of success, which is always the confirmed trend. Ignoring the tape is the fastest way to invite unnecessary risk into the portfolio. This rule emphasizes the importance of observation over prediction in risk management. The speculator's job is not to predict where the market should go, but to observe where it is going and align their capital accordingly. By strictly adhering to the trend, the speculator minimizes exposure to sudden, violent reversals against their position. It is a defensive posture designed to ensure the speculator is always working with the market's momentum, not against its power. The necessity of limiting the percentage of total capital committed to any single trade or group of correlated trades is a core tenet of Livermore's risk management. Overtrading, or excessive exposure, is a direct pathway to emotional distress and financial ruin. A speculator must always maintain a sufficient buffer of uncommitted capital to weather unforeseen market volatility without suffering irreparable damage. The commitment of too much capital to one idea blinds the speculator to other opportunities and increases emotional stress. Livermore analyzed how overtrading, particularly when combined with excessive leverage, leads directly to the devastating effects of margin calls. A margin call forces the liquidation of positions, often at the worst possible time, locking in losses that might otherwise have been recoverable. By strictly limiting the size of any individual trade, the speculator ensures that even if the trade fails entirely, the overall capital base remains intact and ready for the next opportunity. Trade size control is the primary defense against forced liquidation. Crucially, controlling trade size is also about preserving mental capital, which is the speculator's most valuable asset. If a speculator is constantly overexposed, worried about immediate failure and the survival of their portfolio, mental clarity vanishes. Sound, rational decision-making is impossible under the stress of excessive risk. Maintaining an appropriate distance from ruin allows the speculator to execute their plan calmly and objectively. The maximum allowable risk per trade should be a minuscule percentage of the total capital, ensuring that a string of small inevitable losses does not cripple the ability to trade. Overtrading is often driven by greed or impatience, the very emotions Livermore sought to neutralize through rigid rules. By institutionalizing small controlled position sizes, the speculator ensures longevity and resilience in the face of market uncertainty. Livermore identified hope and fear as the two great internal enemies of the speculator. Psychological forces that destroy discipline and lead to catastrophic risk-taking. Psychological risk management is arguably more important than technical analysis, as human emotions are the primary cause of trading mistakes. Hope is the dangerous emotion that surfaces when a trade is losing, encouraging the speculator to hold on and wait for a recovery that may never come. This hope directly violates the discipline required to execute the predetermined stop-loss. The antidote to hope is strict adherence to the rules established before the trade was even placed. Once the stop-loss level is reached, the decision must be automatic, devoid of emotional interference. Conversely, fear is the debilitating emotion that surfaces when a trade is winning, tempting the speculator to liquidate a profitable position prematurely due to the fear of the profit disappearing. This fear violates the crucial rule: let profits run. The risk of prematurely liquidating a winner prevents the speculator from capturing the substantial gains necessary to offset the inevitable small losses. Livermore emphasized that the major profits are made during the sustained, long-term movements, and fear causes speculators to exit before those movements are fully realized. Managing the emotional element requires recognizing that the market is designed to prey upon these very human responses. Success demands acting against natural human instincts. The speculator must actively cultivate discipline to overcome these internal forces, transforming trading into a purely mechanical, rule-based endeavor, allowing hope to dictate the exit of a losing trade, or fear to dictate the exit of a winning trade, guarantees suboptimal results and excessive risk exposure. The professional speculator manages their capital by managing their mind first. The rule to always maintain a substantial portion of trading capital in cash is a fundamental risk management strategy that ensures survival and flexibility. Livermore understood that liquidity is a strategic weapon, providing the ability to exploit major, clear opportunities when they finally emerge from the chaos. Cash in reserve provides the ultimate defense against unforeseen market shocks and prevents the operator from being forced to liquidate assets to meet immediate needs. A fully invested speculator is a vulnerable speculator. The danger of full commitment is that it leaves the operator unable to react decisively to unexpected market shifts or profitable crashes. When a major correction occurs, the fully invested speculator is forced to watch from the sidelines, unable to purchase assets at distressed prices. The speculator who maintains significant cash reserves, however, is positioned to swoop in and capitalize on the fear and distress of others. Liquidity provides the optionality that is essential for long-term success. Livermore's emphasis was that most of the time the risk of action significantly outweighs the benefit, making patience and reserved capital the safest and most profitable strategy. The market does not offer high probability opportunities every day or even every month. By keeping capital in reserve, the speculator avoids the temptation to trade marginal setups, waiting instead for the big fish that offers overwhelming confirmation and minimal relative risk. Cash is not merely sitting idle, it is standing ready. This rule protects the speculator not only from market volatility, but also from their own impatience. The reserved capital acts as a psychological buffer, allowing the speculator to wait months if necessary for the perfect setup. This financial discipline ensures that when the market finally moves in a clear, sustained direction, the speculator has the necessary firepower to deploy capital effectively and scale into the winning position. The mandatory step of determining the exact price level where the trade will be liquidated. Before the order is placed is a non-negotiable aspect of professional risk management. This pre-trade risk assessment ensures that the speculator knows precisely the maximum capital allocated to testing the initial judgment. By defining the stop loss beforehand, the speculator transforms the decision from an emotional reaction into a mathematical certainty. This is the cornerstone of disciplined execution. This rule eliminates the immense emotional risk inherent in deciding where to exit a losing trade while under the stress of market movement. When prices are moving quickly against a position, the human tendency is to hesitate, rationalize, or hope for a reversal, which leads to disastrous delays. Pre-commitment removes subjectivity entirely. Once the price hits the predefined level, the trade is automatically terminated, regardless of the speculator's current feeling. The stop loss is the ultimate definition of capital risk limit. The stop loss must be placed at a logical point that invalidates the original premise of the trade, not merely at a random percentage. It must be based on technical analysis or market structure, identifying the price level where the market confirms the initial analysis was incorrect. This ensures that the risk taken is proportionate to the potential reward and is based on objective market signals. Defining the maximum capital allocated to testing the initial judgment is the purest form of risk control. Adherence to this rule forces the speculator to think defensively before initiating any position, considering the exit strategy before the entry. If a logical stop loss cannot be identified, or if the risk required to place that stop loss is too large relative to the potential reward, then the trade should not be taken at all. This mandatory pre-assessment filters out poor quality setups and protects capital from ill-conceived ventures. Livermore's final golden rule of risk management is a powerful warning against the risk of external influence. Never act on information, tips, or inside stories. Regardless of the source, relying on external information transfers the responsibility and control of the trade away from the speculator, introducing unquantifiable and often catastrophic risks. True speculation must be based solely on personal observation, analysis of the tape, and confirmation of price action. The danger of tips is twofold. First, the information is usually stale, and the smart money has already acted upon it, leaving the recipient holding the bag. Second, and more importantly, acting on a tip bypasses the essential process of developing and trusting one's own judgment and discipline. If a trade goes wrong based on external advice, the speculator lacks the intellectual framework to manage the risk or determine the correct exit point. All risk decisions must be based on verifiable personal analysis. Livermore learned through painful experience that tips rarely serve the interests of the recipient and often lead to poorly timed entries and excessive risk-taking. The source of the tip, regardless of their reputation, cannot control the market's reaction or the timing of the movement. Speculation is a solitary endeavor that requires complete self-reliance and accountability. Outsourcing the analysis is outsourcing the risk management, which is unacceptable. This rule insists on personal responsibility for every dollar risked in the market. By focusing solely on the price action and volume, the objective reality of the market, the speculator minimizes exposure to manipulation, misinformation, and emotional hype. The speculator's capital is too precious to be risked on unverified rumors or the subjective opinions of others. Trust the tape and trust your own confirmed analysis, nothing else. The synthesis of these 10 rules reveals the overarching theme of Jesse Livermore's success. His profound achievements were rooted in highly disciplined risk management, not prophetic insight or uncanny luck. He did not succeed because he could predict the future, but because he had an iron-clad system for preserving his capital during times of uncertainty and maximizing his exposure during times of confirmed trend. Livermore understood that the market is a battlefield where survival is the first priority. The primary job of the speculator is fundamentally defensive. It is not to predict the next market move, but to protect capital and wait patiently for inevitable clear movements that offer asymmetrical risk-reward profiles. These rules provide the framework for that defensive posture, ensuring that the speculator is always prepared and never overcommitted. They eliminate the most destructive forces in trading: emotionality, impatience, and overexposure. Livermore's methodology teaches that the most important decision is often the decision not to trade, reserving capital until the odds are overwhelmingly in one's favor. His lessons emphasize mechanical execution over intuitive feeling, recognizing that the market will expose and punish any lack of discipline. The rules are timeless because they address the unchanging risks of human psychology and market volatility, proving that true success in speculation is achieved through intellectual rigor. The legacy of Jesse Livermore is one of enduring discipline, a master class in capital preservation that remains entirely relevant today. His story, filled with spectacular gains and devastating losses, serves as the ultimate proof that the rules work, provided they are followed without exception. The principles outlined here are the essential guideposts for any speculator seeking longevity and consistent success in the unpredictable world of the stock market. If you wish to delve deeper into the mindset and strategies of this legendary figure, there is no better resource than the classic text that documented his life and methods. We highly recommend the new edition of Reminiscences of a Stock Operator, the definitive work by Edwin Lefebvre. This updated version offers a profound analysis of Livermore's psychology and strategies, enhanced with unique modern commentary and a detailed breakdown for every chapter. It transforms his historical experience into practical, actionable lessons for contemporary traders who struggle with discipline and risk. Reading this book is essential for internalizing the wisdom required to master these 10 golden rules and turn them into automatic habits. Check the description below for the link to acquire this indispensable classic.